Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out if companies are actually making money or just good at pretending to in their latest SEC filings. Today we are diving deep into TG-17 Incorporated, also known as Bond, and their S-1 filing part 2 as they prepare to hit the public market. This filing is all about them telling the world how they plan to sell shares and what the company is all about before they start trading on NASDAQ. So, can Bond actually deliver on its promise of preventative personal security powered by AI, or will this be another tech IPO story we see too often? Let's find out. Here is the big picture. Normally companies go public to raise money for themselves, but Bond is different. They aren't selling new shares to fund operations. Instead, existing stockholders are selling their shares. This is called a resale prospectus, and it means Bond itself won't see a dime from this specific offering. The main goal here is to unlock liquidity for those early investors and provide a pathway for their shares to be traded more openly. Think of it like this: Apple shares are already out there and people decide to sell their personal holdings. That is kind of what is happening here, except it is a significant chunk of the company. And a big deal about this offering is that it is a direct listing, not a traditional IPO. This means no big investment banks underwriting the deal. It is a bit more direct and can sometimes lead to more volatile trading prices right out of the gate because there is no established IPO price point to anchor things. They are hoping to list on the NASDAQ global market under the ticker symbol OBI. Now for the nitty gritty, the risks are pretty extensive. They're dealing with developing technology which always comes with uncertainty. Security breaches are a major concern, especially when you are handling personal information. And let's be honest, privacy regulations are constantly changing, making compliance a moving target. They also point out the risk of relying on third-party services like Amazon Web Services, which could disrupt their operations if things go wrong. This is a huge red flag in their risk assessment. In 2024, one customer alone accounted for over 63% of their total revenue. For the first 9 months of 2025, that same customer still represented over 51%. That is a massive concentration. If that one customer decides to leave, it would have a devastating impact on Bond's finances. This reliance on just a few big clients is a classic warning sign. They say they are trying to diversify, but that is a long road ahead. And here is another big one. Their founder and CEO Doran Kemple will hold about 98% of the voting power after this listing. This means he has almost complete control over the company. While a founder's vision is important, a lack of independent oversight can be a major risk for minority shareholders. They mention they might rely on exemptions for controlled companies, which could mean less independent board oversight than you'd expect from a typical public company. Let's look at the financials for the year ending the 31st of December, 2024. They reported a net loss of over $11 million. In 2023, it was even higher at over $12 million, and even for the first 9 months of 2025, they are showing a loss of nearly $8 million. This isn't just a little hiccup, they've been losing money consistently. They anticipate continuing to operate at a loss for the foreseeable future. This means they will likely need to raise more money down the line, which could dilute existing shareholders. That phrase you see about unable to continue as a going concern is serious. It means without more funding, they might not be able to keep the lights on. Their total revenue did increase by about 35% in 2024 compared to 2023, reaching almost $9.8 million. That sounds good, but remember the losses deepened. For the first 9 months of 2025, revenue also saw a slight uptick, but their cost of services sold also increased, eating into any potential profit. This is where the cost of running their service, primarily command center operations and outsourced security services, comes in. While their revenue grew, their cost of revenue grew even faster in 2024, jumping by about 48%. This means for every dollar of revenue, more of it is being spent just to deliver the service. Looking at their operating expenses, general and administrative costs are the biggest chunk, over $6 million in 2024. Research and development also jumped significantly in the first 9 months of 2025 by about 7%, partly due to currency fluctuations, but also increased spending. Sales and marketing jumped a whopping 60% in 2024, showing they are trying to push growth, but that hasn't translated into profitability yet. On their balance sheet, as of the 31st of December 2024, they have about $726,000 in cash and cash equivalents, but they also have over $20 million in liabilities. That is a pretty tight spot, and it reinforces that going concern warning. By September 2025, their cash hoard had grown to just over $925,000, but their liabilities also increased, showing that the cash burn continues. Now let's talk about who owns what. Doran Kemple, the CEO, holds a significant amount of voting power, around 98.16%. This aligns with the controlled company risk we talked about. Other key shareholders like Ascent Parfund LLC and Eastwood F Management LLC also hold substantial stakes, mostly in preferred stock which would convert to common stock. It is important to note how much of the company is tied up in these preferred classes, as their conversion terms impact the common stock landscape. Ascent Partners Fund LLC is a major player holding over 28 million shares of common stock that could be sold through this filing. That is a huge number of shares potentially hitting the market, which could put downward pressure on the stock price if they all decide to sell. In terms of leadership, they have a CEO, Doran Kemple, who is also the founder with a strong background in tech and business. Their CFO, Amit Hod, comes from a finance and audit background. Joseph DeSalvo, the head of global security, has an impressive resume with experience in corporate security at Blackstone and as an FBI special agent. Michael Lambert heads up commercial operations with sales leadership experience in tech. They've also nominated 3 independent directors, Adam Dreisen, Paul Morin, and Randy Boughton, all with impressive backgrounds in private equity operations and cloud technology. They seem to be assembling a competent, if not small, leadership team. Bond's big idea is to offer preventative personal security, essentially a 24/7 bodyguard service for everyone. Accessible through an app, they combine AI for threat detection with real-time human agents in command centers. They believe they are filling a gap between everyday unease and a full-blown emergency that warrants calling 911. They claim to have handled over 1.28 million requests, including thousands of emergencies. They claim to be unique, offering something called pre-emergency, preventative 24/7 personal security. They identify competitors like Noonlight and Motorola Solutions, Panic Button, but argue these only offer basic emergency alerts, not the preventative look after me service they provide. Their investment in technology is considerable. Over 350 engineer years, which they estimate at around $70 million. Scroll note, looking at the financials again, this whole story hinges on their ability to scale and find more customers who will pay for this preventative security. With significant customer concentration and ongoing losses, the path to profitability looks challenging. The direct listing also adds another layer of uncertainty. It is a less traditional route to public markets, and without underwriters to stabilize early trading, we could see significant price swings. In conclusion, TG-17 Incorporated, or Bond, is offering a novel service in a potentially massive market. However, they face significant hurdles, substantial customer concentration, a history of significant losses, a strong reliance on their founders' control, and the complexities of a direct listing. Their technology is innovative, and their leadership team seems experienced, but the financial reality is concerning. Investors need to weigh the potential for growth in the personal security market against the very real risks of a company that is still burning through cash and heavily dependent on a few key clients. It's a high-risk, potentially high-reward situation, typical of many direct listings, but the financial foundation needs to strengthen quickly for this story to have a happy ending. Alright. That is our deep dive into TG-17 Incorporated, or Bond's latest filing. What is your take on their business model and these financials? Are you buying into the preventative security dream or staying away from the risks? Let me know your thoughts in the comments below. If you found this analysis valuable, smash that like button and subscribe for more corporate breakdowns. And hey, join our Discord community linked in the description for more in-depth discussions and to connect with fellow corporate explorers. Thanks for watching, and I'll see you in the next one.